This is Econo Days calendar. And tomorrow is the day before CPI on Tuesday. This is the day that the market's going to get wrecked. It's going to be a mess. So you want to be very, very careful and don't participate at all on Tuesday prior to CPI. Now, after CPI hits, there's nothing wrong with going after whatever remains in terms of liquidity or imbalances. But prior to, you don't want to do that. Okay, you don't want to do that at all. So be mindful of that for this week and the rest of the week calendar. I'll talk about that as we go via Twitter. But Monday's kind of light, and because it's ahead of CPI, our expectations are not terribly elevated because of the news driver that will be on Tuesday, which is usually a one-shot, right away, one-way street, just completely runs over top of the market. So just be careful with that. All right, so you should be seeing the dollar index chart now. All right, so we have a daily chart of the dollar index, and here's the weekly chart. Now, right away, one of the things I noticed first glance with you is we have taken out a short-term low on the weekly chart of the dollar index. We have overlapped entirely the gap that's between this candle's low and this candle's high. We have this large wick here. So midpoint of that, you want to annotate that for consequent encroachment. So it looks real close to this candle's opening. So we came back down inside this buy side imbalance, sell side inefficiency, this candle here. And we've already completely overlapped the weekly gap. So we have buy side here, an old volume imbalance here. So this volume imbalance, this buy side liquidity pool, and the weekly consequent encroachment level on that weekly gap high. Those three levels are my premium arrays that I'm watching going forward for this week. The discount arrays for the dollar is the consequent encroachment of this wick here. Now, let me remind you, I do not know where the market opens on Sunday. No one does. That's a complete mystery. So we all have to wait and see how the market itself starts its week. Whatever that new opening price is on Sunday, that's when we have the data to start working with it. Right now, we have no idea where it's going to open. So I have to give my students, and I have to record my observations, both premium and discount. I cannot frame a narrative. Now I'm going to share with you what I think might happen this week. Don't read that much into it because it's before Sunday's opening. Right now it's 10 minutes or not, 10 minutes or so before 10 a.m. Sunday morning. So we have hours before the market actually opens up. But I'm hopefully inspiring you to look at both sides of premium and discount. And then when we open up, what do we gravitate towards? And then obviously keeping our expectations low on Monday because the CPI number that comes out on Tuesday, that's the real carnage. That's the move that's going to do a lot of the violence. And I'll give you my opinion what I think might happen. I've been wrong a lot with CPI. When I try to forecast what they're going to do beforehand, that's why I don't trade ahead of it. Because if I had a method to trust what it was going to do beforehand, look how fast it moves. It's typically moving anywhere between 50 to 100 plus handles when it's released. So when the market absorbs that CPI data, it's just like, wow, it goes and just immediately rips. And you don't want to be in that on the wrong side. So do not try to trade ahead of CPI. It will hurt you. So the discount arrays for the market, which is below market price, we're assuming if you looked at the chart right now and it was live data, market price, the closing price right here is 103.578. So below that price, we have this low for sell side liquidity. We have the buy side imbalance, sell side inefficiency, consequent encroachment, which would be here, which is also pretty much the consequent encroachment of this wick, the midpoint of the wick. Okay. And we have a volume imbalance down here. So make sure those are annotated on your chart going forward. As soon as the market opens up on Sunday, you're going to make a measurement of the midpoint between Friday's closing price, wherever Sunday's closing price is, and the difference between the two. That's consequent encroachment for the new week opening gap. You'll do that for every market that you follow. If you're Forex, you're going to be dealing with dollar index and whatever Forex pair you trade with. Since I'm teaching predominantly with the medium of the E-mini S&P this year, we would be doing that with the opening price on Sunday in relationship to Friday's closing price on E-mini S&P, and then splitting that range in half. And in that entire range, those three specific levels, we carry that all the way through till Friday's close, because the market's going to refer back to it. As many of you already discovered, that's a true statement, and it repeats. So those are the levels for dollar index I like. And we're going to go into euro. All right, so I kept some lipstick on this, and I didn't want to have it on there. I apologize. So you can see what we talked about before and the reactions thereof. The buy sell liquidity pool, they swept that, took it up into the fair value gap I mentioned. If we get above here, it can expand up into that. We went up into it here, we broke down. Small little fair value gap in here, which we repriced to here yesterday, or Friday rather. We had a nice displacement lower. You want to carry that range out, because if we go through it and come back up, it may act as resistance. The low and the midpoint of it, consequent encroachment, which is based on this candle right here, the 9th of January 2023. So that daily candle is your fair value gap on your daily time frame. If we accelerate lower with higher dollar, sell side's the next draw on liquidity. You want to use the consequent encroachment of that wick as well. So it could come down here, just fall short of it. I'm assuming, I'm taking a great deal of liberty by saying if it does go lower, because that's pretty much already indicating what I'm expecting. I'm expecting higher dollar. I'm expecting lower prices on other assets like equities and Forex, foreign currencies. So if we do break lower and we get this weakness, midpoint of that wick right here, consequent encroachment, it could drop down there, not take out that low. So in your notes, anytime there is a short, stubby little wick, okay, and what do I mean by that? It would look like, look how big the candle is here. Let me zoom in a little bit. Okay, see how long this candle is, and then how little the tail is, the little wick. That to me is a very short, stubby little wick. In relationship, how am I basing whether a wick above a candle or below a candle is stubby and short? It's relative to its candle size from high to low. So that way there's your reference point. Versus something like this. So you have a long wick, and it's the majority of the entirety of the candle. See that? So in relationship, this tail or wick on the low of the candle is short and stubby. And many times you're going to find, this is what you want to have in your journal and in your study notes. Many times that type of low will get probed without going through it. And it'll stop at consequent encroachment for it right there. So in other words, give you a visual of what I'm referring to. It could drop down, come right to it, or just below it a little bit, and then retrace, and then at a later time come back down through it. Whereas a long-wicked candle, generally, if you're on the right direction, in other words, if you're looking at a wick like this and you're bearish, Many times it'll go right to consequent encroachment and stop dead in its tracks and go the other way. Or if it's really weak, it'll only go up like 1/4 of the wick, stop right there, not even go to consequent encroachment, and then drop. The instances that it does that very thing, that is a real hardline indicator that you are in a very bearish market. Because generally you want to see the algorithm reprice back to consequent encroachment of a wick. If you're bearish, if it's a very, very long wick like that, consequent encroachment, which is the midpoint of the long wicked gaps, they're barriers. But if it can't even reach that while you're bearish, and it goes to the quarter range of the entirety of that wick, not the full body high and low, where the wick is generated from the high down to, in this case, because it's a higher closing candle, you'd be using that closing price to high. And those relationships will serve you well if you go forward. The other thing I want to teach about this morning for wicks is when you have a area where the candles create a wick, like for instance, like right here. See that? The body comes down essentially to the old fair value gap high there. And then the next candle we open here, we trade back down to the body of the candle. The opening, or the high end rather, of the fair value gap on this candle right here. But we have this wick on this small little down closed candle right here. The next candle, when it opens and trades up and comes back down, if we have this candle here go up to what would be almost essentially the midpoint or consequent encroachment of the next candle, we don't even know that it's going to create this pattern, but we don't know it. But should it form that, generally you will see the consequent encroachment of that wick. If it's bearish, it won't reach it, and you can see that happening right here. I'm not cherry picking that. I'm showing you to go into your charts and you'll see that is the case, because this candle here is a precursor. Then you get the actual wick here that's on the high. And when you see me sometimes taking live executions and I'm entering trades, I'm sometimes using that very criteria right there and trusting that as I'm seeing the candle open and trades right up to that point here, I'm trusting that it won't even go through consequent encroachment. I'm not fearful of it, because it's that type of signature I'm looking for. It's kind of like justify the confidence behind the idea. So anyway, we have the order block here. So that high, which is the level it's already being shown here, make sure your fair value gap is noted. So if we go through the low end of it, which is this candle's high, so this candle's high on the January 6th, if we trade through that to the downside here, I'm expecting the low of that rectangle, which is the high of that candle here, and consequent encroachment, which is the midpoint between January 10th's low and January 6th high. So you would split that in half for consequent encroachment. So I wouldn't want to see it trade back above that level. If we go below it, leave that range and then come back and touch it here, or go as deep as, but preferably not, the midpoint of that fair value gap that's shaded in blue. And then I would look for a run into this wick and or consequent encroachment. Now, if we do take out this low, go over here to the left, there's no imbalance in here. There's just a small little sell side liquidity pool here. There's really no balance in here. I'm sorry, no imbalance here. Nothing in here, because this high is pretty much this low. This candle's high is pretty much this candle's low. There's no imbalance in here because this completely overlapped this. So the next period of liquidity would be here. My interest would be there. So am I saying that it's going to be a straight crash down there? No. But I'm thinking if we do get below this and we start respecting all of the premium arrays, and anything that would be considered bullish keeps getting broken to the downside, which is what institutional order flow entry is all about. We want to be looking for those types of things, supporting it. So order flow needs to be bearish. When you're going lower in price and you're expecting it to deliver to a discount objective or target, you're looking for up close candles to provide resistance, and any fair value gap really keep price at bay from going higher. And you want to see the low of the fair value gap or consequent encroachment be the defining boundary for any kind of retracements. And then once it gets to those levels, you want to see that it sharply moves away with speed. It doesn't like to hang around there. If you have those signatures while you're watching price print lower, you are watching a sell program deliver, and order flow is bearish. You don't need trend lines, moving averages, depth of market, ladders, volume profile, none of that stuff. You don't need any of it. And you're just reading the actual high, low, and close price and the feed that's being delivered real time. So we could be seeing a surge in dollar. We could be seeing a decline in foreign currencies and equities. There's a lot of saber rattling, and I'm not going to talk too much about what I mean by that, but if you just look at the headlines, certain countries are making pretty bold claims about what they're going to do in retaliation to certain things that other countries have done or implying that they have done. And that is a cause for concern, and that's going to cause what? A risk-off scenario. Risk-off means it's going to be a flight to quality. Generally, what that means is risk-off is the dollar gets bought up. So higher prices in the dollar will pressure foreign currencies. So even if you have a buy signal in Forex pairs or equities or index futures, in those conditions where dollar's rallying, it's real hard for those markets to get traction. They might rally against it for a short period of time intraday, but it's usually short-lived, and then finally it'll just be like, wilt, and it goes the other direction. In relationship to a higher dollar, everything else usually drops. And it's that teeter-totter effect. One goes up, the other goes down. So it's a back and forth type of balance. But don't think that it can't, in intraday price action, move in tandem for a very brief period of time, which can be confusing for a new trader or someone that's expecting it to be lockstep, where every little tick up in the dollar sees every little tick lower in index futures or equities or Forex. Sometimes you'll have that little crack in the correlation where it can be confusing, which is why you want to have intermarket relationships and analysis in your trading. Like, I don't trade the Dow. I can't stand that. I can't stand that index. It's just too spotty. I don't like it. Okay. It tends to overreact more sporadically than the NASDAQ, where NASDAQ can overreact and overdeliver versus the S&P. S&P tends to be much more smoother, more controlled. Let's put it that way. Smoother. Doesn't have as much erratic over exaggerations in price. Dow can be like that, but also it can do things in ranges and chop around before moving in tandem with NQ and or ES. So real quick, I'll do GBP and then we'll get into the business with ES. All right, so here is pound dollar. And let's assume for a moment that I'm correct. I don't know if I'm going to be correct, and you shouldn't assume that I'm going to be by default. But let's assume for a moment that dollar does in fact go higher, and CPI number causes the dollar to rage higher and index futures to drop hard, Forex pairs to drop hard against the higher dollar. That would, in my mind, lead to a potential run on cable below this low and below the sell side here. We have this imbalance here that we didn't come all the way up into. I like that. I like the fact that we couldn't even come back to this old low. Remember what I was saying earlier about the relationships of the wicks in the candles? When they fail to reach the midpoint of the wick, and they're like it's a high, for instance, something like this. Okay, you're looking at that type of candle, and if you're bearish and the next candle tries to get up there but fails to get to even the midpoint of it, which is consequent encroachment, that indicates that you're really bearish. And the same when I look at a gap like this sell side imbalance, buy side inefficiency, which is a fair value gap. By classification, the PD array is fair value gap. What kind of fair value gap? A sell side imbalance, buy side inefficiency. SIBI is what I usually abbreviate it in my charts. It's sell side imbalance. That means it's all one-sided, one big candle. going down. It's lacking efficiency on the buy side. In other words, it needs to be offered at a later time with movement higher by price. The difference between this candle's low and this candle's high frames that SIBI, the sell side imbalance, buy side inefficiency. The market tends to want to reprice back up into the range and as far as the previous candle's low. If we see something like this, I like that. I like to see it in my intraday charts, in my intraday charts for my intraday trades, and it's just what I'm expecting to see price do. I like the fact that we did this here, but we have to be mindful because we went simply below this Thursday's low, and we closed pretty much right at it, or, well, let's look at the difference here. The low is 1.20572, and the close, yeah, we're just above the close, but essentially almost the close is just a little bit above the high. I mean, the low tick of this candle here. I would have been warning you, saying that we closed down below it, and that doesn't necessarily mean it's going to be immediately lower. Because I see this, and this is what you want to write down in your notes too. Be very careful about what I'm about to say. Because I'm giving my opinion, and it's before Sunday's gap, well, before Sunday's opening, I don't know if there's going to be a gap. It can open relatively unchanged. And that would be expected, frankly, because CPI is on Tuesday, and the market's going to be not terribly interested in doing a whole lot before that, because that's the main event. That's the big ticket event for this week, CPI. Everybody knows that's been trading that CPI is that tornado. It's that tsunami. It's the weapon of mass destruction, okay, where the market just simply gets destroyed immediately, and anyone that's in the wrong side of the marketplace will get hurt. So because I'm expecting that carnage on Tuesday like every other trader is, Monday's trading probably will not be all that eventful. I could be wrong, but I don't suspect that there's going to be a whole lot of movement ahead of CPI. Can you trade on Monday? I believe you can, but I don't want you to think massive big range unless they start shooting down all kinds of Foo Fighters, and then it's all over the news. It's probably going to cause all kinds of weird stuff to happen then. And I'm being obviously facetious when I'm saying that, but if we're expecting lower prices, the best signature on Sunday's opening would be a gap lower opening, and then a rally back up into it overnight or into Monday morning, and then does it show a willingness to want to go lower? If it does that, and we're leaving like intraday lows on Monday that are relatively equal, and then we roll into Tuesday and those relative equal lows are still there on Tuesday ahead of CPI, that I'm going to feel further emboldened that that's where CPI is going to rush through and then dig into something like this low here, causing dollar higher and pound getting wiped out below that low right there with a large range on Tuesday. So that's what I'm doing generally on Sundays. Well, not Sundays. I usually do my analysis on Friday nights late or really, really early on Saturday before everyone wakes up. So I'm looking for, in my mind, a lower gap opening on Sunday. But because of, this is important to write this down, because CPI is the big event on Tuesday, it isn't really needed to see a big gap lower opening. It might be relatively close to where we closed on Friday, indicating what? When I see that, if I see that, then I think that Monday will be really quiet and we're going to be waiting for CPI. And that's a reasonable forecast. That's something that anybody technically would reasonably expect to see in price. And why? I just explained it. But now watch what happens. If we see a gap lower that's big, that creates a really good trading opportunity for Monday, even though the big event is on Tuesday. Why do I say that? Because the difference between where we closed on Friday and where we gap open on Sunday, if that's a large gap, on Monday morning, there will be a tendency for that market to want to rally up into the range that's created by the gap difference of Friday's closing price here and where we open. And I'm actually talking about S&P while I'm looking at the British pound, but it's okay, it's fine, because even though they are different, they're going to trade sometimes very similarly because of risk on, risk off factors. So while we won't necessarily see the gap the same way we would see in S&P, because if you toggle, and I'll show you when we get to the S&P, but there's no way of toggling like regular hours and electronic hours for Forex. It's always the same thing. Once we start trading on Sunday until we close on Friday, it's all continuous delivery. So you have to look at gaps and separations between trading sessions differently. And I'll teach you more about that as we go through this year. But if there's a gap in ES, like I taught you last week, and my private members are aware of, this is how I teach the indices market. You need to be considering what we did the previous session, how we closed, and where we opened at 9:30, because that difference, that is a real liquidity void. Write that in your notes. Okay. The PD array that opens at new day and at new week, they are liquidity voids because there's no trading that took place at all. So to answer a lot of questions I've been getting, what are those? They're named obviously new week opening gap, which is the difference between Friday's closing price and Sunday's opening. Regardless if it's a higher opening on Sunday or lower than Friday's close, the difference, whatever that is, that's new week opening gap. As a PD array, a very specific element of price delivery, it is a liquidity void, a real liquidity void. This right here has been unfortunately labeled inappropriately as a liquidity void. Even though it was a down close candle, what it is it's a sell side imbalance, which means it was primarily too much of one-sidedness going lower. So the algorithm will want to reprice to offer fair value by going back up like it does here. The fact that we didn't come all the way back up to that area here and close into this candle's low, to me, indicates that that is weak, decisively weak, because of the same characteristic that I taught you with the wicks. If we can't climb up to the midpoint of a wick above a candle and we're bearish, that is extremely indicative of a lower moving market. So it's those types of things that I'm weighing as each candle's forming, and you'll hear me talk about it when we're doing live streams. I'll say, this is interesting to me. This is what I'm wanting to see. I don't want to see these types of things. If I say something like, okay, I don't want to see that right there. It's just something I don't want to see this right now in the context of what I'm looking for. And I have to see it have a resolution to that immediately. So anyway, I say all that to say that I do believe that CPI is going to be probably a instigation to a higher dollar and a lower factor for like index futures, stocks, and Forex. That's my opinion right now. That can absolutely change based on what we do on Sunday's opening. So let's go over to ES. All right, so here's the daily chart. If we look at the daily chart of the E-mini S&P here. Let's just go up to the weekly chart. All right, so we have a swing high that's formed after taking out this high. Excuse me. We did go above these relative equal highs, which is what I mentioned was the draw on liquidity when we were down here. We ran up through that here on Thursday. We challenged it on Friday, and they said not anymore today. So we had a little bit softer close on Friday. We could not get down to encroachment of this daily candle's wick. Note that, okay? So on your daily chart, you're going to have these levels and carry them down into your lower time frame charts. On the ES, on the weekly chart, we have consequent encroachment of this wick. Make sure you have that noted. Even though we've gone above it here with this candle's high on Friday, keep that consequent encroachment on that wick right there and add this one. Be mindful of the opening and the high of this down close candle here. Extend that out in your charts. Now, as a way of differentiating any levels that I have on one particular chart I have in my array of monitors in front of me, anything from a monthly or weekly time frame, I use the biggest, boldest line. So let's go down to the daily chart real quick. All right, so here is the daily, and we have a volume imbalance here, and we had a volume imbalance in here. So I mentioned, I don't remember where I mentioned it, but because there's two of them here, you want to have all four of those levels annotated on your chart. So this closing price, this opening price, and then have the same color scheme for both of them, and then a different one for this closing price and this opening price. Why? Because they're two different respective volume imbalances. One is during the up delivery for buy side. Notice the candles are up and the next candle's up. This one here is a down close candle and the next candle's down close. So you want to make the distinction between that and how price, if at all, returns to either one of them. So you want to use like a very large number 4 level width on your charts for annotation. And like say this might be, I don't know, it could be green because it's green candles. And it could be a heavy black number 4 thickness because of these being down close. And that'll help you understand which one it's referring to. Now you might look at this and say, well, what's the big deal? They're almost the same. It's a big deal because they're going to respect very specific levels if they come back to it. And if they do trade them this week, once it does that, I'll come back and show you what I want you to take away from it. But not having them on the chart, you won't have the benefit of knowing, whatever may be a follow-up discussion. They might not even be a factor this week. They may not even go there. You don't know that right now. We haven't even opened a new week yet. But I like those two volume imbalances. I have those levels in mind on my notes. And we have consequent encroachment of this wick here. So be mindful of that. Consequent encroachment on this candle. Keep that going forward. You want the mean threshold of this down close candle, which is the midpoint. So you put your Fibonacci on the low to the high. Whatever the midpoint level is, carry that all the way through this week. You want to also note the opening price on this candle here, which is 4077.00, because that's an order block. We've dug into the body of that candle here. So the most important point from now on is if we're bullish, we shouldn't see it go below the mean threshold, which is half of that. But if we open higher, come back down and stop at consequent encroachment or fail to even go that lower, then we're going to go back up inside this gap here. So that's how we would use the information for an example. And I think that's going to be it for the daily chart. So weekly and daily, those are your key levels. It's not a lot, but those levels you want to have annotated. Record them also, what they are. Don't just have the levels there. Write down in the description, like inside the trend line. Okay, there's a way of annotating with the text feature on TradingView. Annotate what those levels are, meaning the opening price on January 30th daily candle. Just in a very, very small font. Make sure your level's annotated like that. And then the consequent encroachment, the mean threshold of the order block, the same thing. You would have that annotated as January 30th mean threshold daily bullish order block. All right, so let's go down into a 60-minute chart, an hourly. Okay. On the range, what my eye is doing is I'm looking at this low all the way up to this high, and I'm looking for a midpoint without even having a Fibonacci there. Okay, just looking for midpoint. And then we are trading right here essentially at what? Equilibrium. So we are opening up while the market itself traded inside of this large range. Why did I pick this high and this low? Why am I not talking about this high and that low? Right? That's exactly what some of you are thinking. He's in my head. Where was the most dynamic price movement? It's this move here, from here to here. So that dealing range is parent. Everything else, these little minor movements and small little retracements and dealing ranges, they're subordinate to all of the movement from this low up to this high. It's going to be subordinate to what? The relationship to premium to discount from this high to that low. So if you split that in half, I'm this eyeballing it. All of this here and higher is premium. So we're at equilibrium. So what I'm looking at is how much time have we spent in discount or premium, which has been done more. Clearly, we've spent a whole lot more time in what? A premium, inside the range between this high and that low. What has been explored? We went down into a discount a little bit, but look how fast we came back to equilibrium. I don't want to read too much into that because it's Friday. That's what we're seeing, Friday's price action there. And we don't know how we're going to open up. But let's just say we open lower. Okay, say we open lower and we want to come back into the closing price or any one of these daily candles. I'm sorry, these hourly candles can act as the point of which it doesn't need to go back to the closing price on Friday. If we're weak, if we're looking for lower prices and higher dollar, a lower opening could see us come right back up, not completely return back to the closing price. Why? Why would I say that? Because we are essentially closing at equilibrium, and we've had multiple times here, moving back and forth. We don't necessarily need a very clean return rate back to Friday's close if we gap lower. What it's likely to do is, if I'm correct, and I don't know this, I'm just giving you my thought process. You're wanting to be trained by me. You want to see what I do and how I do it. This is exactly what I'm doing. I'm doing it right now, real time, for the first time looking at the charts. I'm telling you what I think and what I'm seeing. If we gap lower and we trade higher, I don't need it to return all the way back up to Friday's close. Whereas if it were a move where, for instance, we ended the day on Friday like here, and we gap down on Sunday's opening somewhere down here, I would expect a full return back to the Friday's close. Why? Because it's really extended. And here we've had back and forth, choppy. But more specifically, it's coming right back to the midpoint of the parent price swing of this high and that low. All of that range, that big explosive movement, it's been resisting going higher. It just keeps coming back, spend some time. One more time, real excitement. Oh, there's a speaker. And then that fizzled out. Oh, we're going to really do it now. It's going to run higher. And then it fizzles out. We've taken out relative equal lows here, so sell side's been taken. The argument for the bulls would be, okay, we've taken sell side out. We should see a gap higher, trade down, try to fill the gap all the way to the close here. Now, see what I just did there? If we gap lower, it doesn't need to come all the way back up to the closing price on Friday because we've had multiple times back and forth in here. And the gap between Friday's close and where we open on Sunday, if it's like 77, 84 in that area, I wouldn't need to see a complete return back to Friday's close. I wouldn't need to see that at all. Because it's indicating what? Heaviness. And it's going to want to do what? Reach into this low, attack the low here, and then you want to have that fair value gap noted, and then the sell side liquidity resting below here. So that's the levels that I'm interested on the downside as discount. But devil's advocate, if it gaps higher, I would expect a full return back down into the closing price. Why? All of this inefficiency we're gapping up into it. We don't know that. I don't know that, but I'm assuming, let's just, for the sake of argument, say we gap higher. And this is obviously a great deal of exaggeration where I'm pointing to. But conceptually, I'm trying to communicate the idea that a gap opening below Friday's close in this instance is not equal to the same expectation I would have if a gap higher formed, because we've already spent a great deal of time up here above the midpoint of the low to high. How many times did we try to rally here and not go higher? 1, 2, 3, 4, 5, 6 times. And then finally, on Thursday, it gave up the ghost and traded lower. Now, we don't know if they've taken the market down here to accumulate the sell stops to send it and reprice it higher. The clue will be how we open on Sunday. Later on today, how we open is going to be influential for determining whether or not this is going to be resuming higher, or if it got lower, I don't need it to return all the way back to the Friday close. And I'm expecting heavy weakness right from Jump Street. And then this low and this low will be Monday and into Tuesday CPI number. That would be my objective based on this. Also note that we've had this high since we traded lower here. We went above it here, choppy, pressed above it here on this high, relative to that high, pulled back one more time, dug into it. It just feels like they had to come off of that discount because this was really, really low. And they did not take out that low here. And it didn't even come down to consequent encroachment of that wick, which should be also noted on your hourly chart. So because we've come all the way back up into essentially equilibrium relative to the high here and here, I would favor a down gap, an opening lower gap later today. And I wouldn't require or demand the market comes all the way back up to it before it goes lower. I wouldn't need that because we've already had multiple attempts to get back to equilibrium and taken out this buy side liquidity that was resting above that high. Flipping the script, if we gap higher, because we've had a run below sell side here with this drop, and that we've climbed all the way back above, I would view that as a breaker. And the closing price, that would be all that's necessary, because then I would interpret it as, okay, they opened it here, traded back down into the range, which is the breaker, which is this candle over here, that up close candle. Extending that candle forward, that should be on your hourly chart. If we gap higher, it can come down and retouch the Friday close, and then I would expect to see it try to reach up into all of this inefficiency. If we gap higher, show responsiveness at Friday's close, and move higher, that would indicate that I'm probably wrong about my expectations on the market, and they might send this thing higher on the CPI on Tuesday. Now, stop for a second. What I just gave you is not plan A, plan B, because I'm telling you, I don't know which one's going to pan out. I have to wait and I have to see what the market does on Sunday's opening. And then I weigh it out based on the things I just explained to you. That's forecasting. That's your own, that's my analysis, but that's your own way of internalizing what you expect to see price perform and deliver. It's not equating to a trade entry. All of that is going to be at a later time. These are things that I'm looking for to justify what? Bias. I don't have a bias right now. I never have a bias before Sunday's opening. I don't ever have it. So it's, in my mind, more likely, and it would be more favorable for me to see a lower gap, not come all the way back up to the closing price on Friday. Show it as weakness, as a breakaway gap. That's why I would like to see that, because then it would indicate to me that it's breaking away from this retracement, which was only taking us back up into equilibrium relative to this low to high, back into this old order flow. All these old lows in here, it pulled back up into that. And look how sloppily it was doing it. It was going up and then come down, up and then come down, up. It just feels like it's just reaching. One more time. One more time. One more time. And it's like that rock climber. He's just trying to swing, get that last bit of a grip, but there's not enough chalk on his hand. It's sweaty, and he slips off. And that's what I'm expecting. That's what I see here. I'm absolutely likely to be wrong. And I'm okay with it because it's Sunday. I don't know what Sunday's going to do. But that's my thought process going into it. Okay, so hopefully you can appreciate that. Don't bet the farm on it. Okay, because if I had a strong inclination about what it was going to do, I would be putting my own money behind it, and I'm not. So it's just an expectation on the marketplace I'm holding. All right, you can see again, 1, 2, 3. Retail's going to see this as a bull flag here, and then wanting to go higher. Now, if we do gap higher, that changes everything, and I'm just giving you all the reasons why that does change it. But here, bulls that went long in this or wanting to go long, they're going to want to see a gap higher, a gap and go type of event. I would like to see a gap higher if I'm bullish. Gap higher, come back into it, return all the way to Friday's close, and then show me willingness to want to rally. That's how I would wait and see. I'm not trying to just simply go in there and blindly buy the retracement back to the closing price. I want to see, does it give me a shift in market structure after that return to Friday's close? Flip the script. Gapping lower, I do not need it to trade back to Friday's close. Because we have all this in here, gapping lower, it can make an attempt to trade higher, leave the gap open partially. It doesn't have to come all the way back to or even halfway. It's better if it doesn't. What would that communicate to me? It's exceedingly weak. It can't even fill the gap. You see, that's what you're trying to do. Whether you know that is what you're expecting going forward every weekend before Sunday, you want to read price, write down what you would expect to see relative to the Sunday's gap opening. Not because you're trying to train yourself with the belief that you're going to know how to do that, because I don't, and I've been doing it for 30 years. I don't believe anybody can tell you where it's going to gap open. If they did, they're way better than me. And they know something that none of us would know. Nobody has that information. So, but you want to be conducting yourself as a means of case study and walk forward testing and building confidence and trusting the fact that you don't need to know this piece of information, but how you're going to respond to that as an analyst. If it gaps lower, what do you reasonably expect to see it do? And what don't you want to see it do? What is not likely to occur? Well, here's an example of something I would not like to see, and I don't think is likely to occur. A gap lower and rate from the opening lower go raging higher. I could be wrong, but the likelihood of that happening is less likely than a gap lower coming up, leaving the gap open, not completely closing it in, and then working lower to take that sell side and maybe dig into that hourly consequent encroachment wick and that wick's low. And that subsequent fair value gap to the left on the hourly chart before we went down to the 15-minute time frame. All right, so we've had 1, 2, 3 times as a 3 dries potentially pattern, and that's why I would also like the fact that if we gap lower, I would put more emphasis on this, reaching, just simply get into the liquidity resting above here. Why was it doing this? Higher, higher, higher. Because the liquidity that was trailed behind this this high, as the market went lower, it was taking that liquidity, starting to break down. What happens then? Any stop that was higher than this was brought back down to what? This high again. They come right back above, skip this high, right back above this high again with this run. Then they start dropping it again. Okay, now I finally did it. Now we can get short. Where's the stop loss at? Right back to an old high. You might be thinking here and here, but my focus and my eyes going right there. And they take it once more time, up above it again. It just so happens that they're taking out each individual high too, which is killing 2 birds with 1 stone. That's how I'm internalizing that price action. It's too compressed, meaning that from the low here up to this high, all of these fluctuations back and forth, even though they made higher highs and I guess higher lows, I'm not convinced that that's something that's bullish. Like, I see that as just constantly reaching for liquidity that would be in the form of buy side, keeping anybody from potentially profiting from a lower gap opening. and never coming back up to those levels again to give them a safe entry, which is what they would want to see. More specifically, not coming back to this old high. So hopefully that kind of justifies what my internalization of price action, what I am forecasting from my own observations. If it does anything other than those potential scenarios, I'm sitting on my hands and doing nothing. Wow. I just gave you the upside if I'm wrong, what I would look for. I gave you the downside, which is what I'm looking for. The things that I just outlined, if the price doesn't deliver those very things, I'm doing nothing, and I'm not going to be anxious about doing nothing. I'm going to be completely content sitting still because I'm going to be requiring more information to happen on Monday at 9:30's opening. Why? Because there's no news event that's going to be of interest to me on Monday. Why? Because Tuesday is the CPI number. It's going to be the big event. A lot of people are just sitting on their hands. There isn't going to be a lot of movement until CPI hits the market. No one wants to assume positions ahead of that number, that report that comes out on Tuesday. So there is not any reason to be excited about doing big moves in Monday, because the big move is absolutely predictable on Tuesday because CPI is bringing it. Hopefully that makes sense, okay? And I think that's going to be it because we've already went down the lower time frame stuff, talking about it real time on Friday.